Hey, Jordan from Condo here. Today I want to talk about the slaughter in the suburbs. So a little bit of a clickbait headline here. Not exactly a slaughter. Actually, it's not as bad as most people are playing it up to be. But we're going to talk about what we're seeing in the housing market, both condos and detached homes in and around the GTA. Let's get right into it. So the first chart I want to start out with here is the G7 countries real house pricing index over the past couple of decades. It's no secret the Canadian market has been doing incredibly well, and COVID has accelerated that trend, right? COVID has accelerated pricing trends for housing markets around the world, but Canada was a particularly strong beneficiary of low interest rate environments. And we're going to talk about that a little bit more. You can see here Canada topping out the chart at number one.
You ain't first, you're last.
Now, a lot of people will say now that you're seeing Canadian housing prices fall 5, 10, 15% across the country on a median or average price basis, you can safely say that it was all investor speculative driven and low interest rates. And to those people, I say yes, to a degree. Low interest rates, of course, fuel the housing market, especially in the immediate market, in the short-term market. They drive affordability. And of course, as a result, they're going to drive housing prices as well. However, it's important to remember that we weren't the only country that drove rates to near zero. The US did as well, and it has always been easier to get a mortgage in the United States. I mean, you can get a 30-year fixed, right? So it's important to remember that that is not our differentiating factor. The fact that low interest rates and high investment happens in Canada is not a differentiating factor. And when you look at the supply side of things, it becomes evident pretty quickly that we are lagging the G7 average as far as housing units per 1,000 residents, right? At 424, we're the lowest. And then when you look at growth rates, and this is just in a gross number of people coming to the country versus the other G7, we are of course the fastest growing, not just in real terms currently anyways, but also as a percentage basis. Of course, we have a much smaller population than the US, so when you see similar numbers of immigration, we're actually doing on a percentage basis considerably more. So let's talk about interest rates and inflation. The Fed hiked 75 points yesterday, right? Generally follow exactly what the Fed does. So I would anticipate a 50 or 75 point hike in the July meeting, right? And that, of course, is basically the story here is it's going to get worse before it gets better. The question is, when does it start to get better? Of course, nobody has a crystal ball. Nobody knows the answer to that. But it's important to remember that the Bank of Canada has made it very clear that they have a dual mandate when it comes to interest rates. They aren't just targeting inflation anymore. They are also watching unemployment. So as unemployment starts to rise, they are going to be faced with a difficult question of can they continue rate hikes? That dual mandate might come into effect sooner than people think. So here's a great graph from Graham. You can follow him on Twitter or you can read his article. I will link it in the description of the average price change by region for all dwelling types. So you can see here Halton is down 14%, Peel is down 10%, Toronto is up 2%, York 13%, Durham at 19%, and Simcoe at negative 12%. So what's going on with Toronto there? Well, it's important to remember that Toronto, this is all dwelling types. Condo prices seem a little bit stickier than detached prices right now. That makes sense because they are the price floor. They are the most affordable segment of the market, and they lag the appreciation of all other asset classes through COVID, so they're least sensitive to rate hikes. But it is important to remember that there's a higher proportion of investors in the condo space, and so they are more prone to fire sales like what we saw during COVID. So right now, condos are effectively propping up the Toronto average. When you dive into by housing type, the numbers get a little bit different. So Graham also has this chart here that shows you from February, so the market peak February of this year versus May of this year. Again, average price and all dwelling types combined. And you can kind of just take a quick glance here and see, King down 36%. Now, granted, King doesn't have a huge sample size, so you have to take numbers like that with a grain of salt because not enough transactions happen for average to really be a good indicator. Median or HPI would be much better. But it's what we have to work with. You can see across the board, we're seeing red from February to May. And again, important to take that in context with the average price change from February of 2020 to February of 2022. So essentially, pre-COVID to the absolute peak of the market this year. And you can see that many markets were up 50 to 100%, sometimes even higher than 100% price growth over those years. So we're only really back to, depending on the segment, right? Depending on the neighborhood, depending on the city, on average, I'd say we're back to September, October of last year pricing. Again, depending on the segment, but general rule of thumb, somewhere around there. Now, condos, we're seeing inventory build. So the prices are stickier. They're doing better. They're certainly the best performing segment right now as far as prices go, but they are seeing a lot of inventory come to market. So I imagine that they're going to see a little bit of price regression as well. We're just not seeing the same level as we are in the suburbs. If you go back and watch my previous videos, previous market update videos, you'll see what I'm talking about because I showed more examples. Just a couple quick ones here. This one's a condo in Humber Bay, sold for $850,000, resold for $780,000. Then you have this one in North York, sold for $900,000, and then it just resold for $838,000. But of course, what we're seeing in the suburbs is far worse. Here's a home out in Acton, sold February of this year, $1.2 million. Buyer would have probably failed to close, just resold for $916,000. Now, this is a cherry-picked example. We're not seeing down 22, 23% across the board. I would say more likely 12 to 15% versus February highs, again, depending on the type of home and depending on the neighborhood. But yeah, you're seeing far more aggression in detached homes, specifically in the suburbs and the exurbs surrounding Toronto and the GTA, than you are in the core, right? And that applies to detached homes as well, as we see more re-urbanization of demand. So like I said, inventory is building. The green line here is months of inventory for condos. Below 3 months of inventory, you have yourself a seller's market. 3 to 5 or 3 to 6 is a balanced market. And then above 5 or 6 months of inventory is a very clear buyer's market. Right now we are sitting at 3. So we are officially just bordering, we're basically in a balanced market for condos. You're still seeing sales. You're seeing prices pretty much as high as they were, maybe down 5 to 8%. But you are seeing more inventory. There's a lot more to choose from on the condo market. You can go to pretty much any building and there's going to be multiple listings. So there's a high turnover right now. And then freehold, you're still sitting at about 2.13. Now, again, this is for the 416. So the months of inventory in other markets as sales kind of drop precipitously is looking a lot worse. But in the 416, it's holding up much better. Which leads me to one of my favorite charts. Durham realtors are going to kill me, man. They're going to cancel me. So this is the average selling price for a condo in the downtown core, right, in the CO1 district, versus your average price for Durham detached. Now, I like this chart because if you go back even prior to 2015, I should have given you the whole chart. But anyways, you go back prior to 2015, you go back a couple decades, and you'll see that, they go through peaks and troughs, but for the most part, a CO1, the downtown core condo, has roughly traded very similar in price over the years to the price of a Durham detached, plus or minus 10%, right? Usually actually within a tighter band than that. But anyways, plus or minus 10%. And then, of course, COVID changed everything. Everybody was looking to the suburbs and buying single family homes. And as a result, you see Durham just skyrocket while condos regress a little bit in price and then trade sideways for a bit and then start recovering in the last 12 months. So you can see here, this gap is shrinking rather rapidly as Durham corrects downwards and as condos, well, they were correcting upwards, but now they're trading sideways. And so, you're starting to see these gaps shrink. The average price of a detached and the average price of a condo are coming closer once again. And again, it makes a whole lot of sense. I've been talking about this for, it feels like years now, since the start of COVID. And it's interesting to see how it plays out. Now, I personally didn't expect things to correct quite this quickly, but I also did not expect prices to run as quickly as they did. So you can see here, Durham detached about back to their September, October pricing. Now, the final thought I want to leave you with is the build GTA numbers. So they release cost guidance for developers. It is officially going to cost, with the addition of inclusionary zoning based on builds estimates, just over $1 million to build a 750 square foot condo in Toronto. Now, this is particularly interesting to me when you add up all of these city and government related fees. So for example, parkland levies, development charges, permit fees, your federal and provincial taxes and fees, and then of course now the new addition of inclusionary zoning, which reduces the amount of saleable square feet you have in a building, looking at over $237,000 in just government related expenses before you even talk about land, materials, labor, that kind of thing. So you're north of $1 million, which is basically $1,300 a square foot. So when you're looking around at all these new pre-construction launches going, why is everybody at $1,500 plus a square foot? Well, this is your answer right here, because it's costing $1,300 just to build it, or a little bit less because we don't yet have inclusionary zoning or many projects that have it included yet anyways. And so as a result, you got to add a 15% builder profit margin on top of that. and you get to $1,500 a foot very, very quickly. So my question is, how does housing get more affordable when supply is being constrained? If condo prices trade sideways at $1,000 or $1,100 a foot and pre-construction is $1,400 to $1,600 a foot, developers will launch less new housing supply. They'll launch less new condos if the market won't absorb them. And if the market doesn't absorb them, then those homes don't get started. And as a result, you see more supply constraints in the housing market, which is, of course, a problem for an undersupplied market, which eventually creates upwards pressure on the resale prices. So this chart and basically the supply and demand equation of Toronto is why I'm long-term bullish on housing in Toronto. It's very expensive to build new homes. It's more expensive to buy new homes than to buy existing housing stock. And the city of Toronto seems hell-bent on making it more expensive. So that's all I have for this video, guys. If you like this type of content, please like and subscribe, and I will catch you guys next week.